In 1985, a 27-year-old warehouse supervisor named Frank Doyle made one small decision, and for the next 4 decades, history tried 5 separate times to convince him it was the biggest mistake of his life. He didn't know any of that yet. All he knew was that he had just started putting $250 into the stock market every single month. The first gut punch came just 2 years later, October 19, 1987. Wall Street still calls it Black Monday. The Dow Jones dropped 22% in a single trading session. Not in a month, not in a week, in one day. Traders were sprinting off the floor. News anchors were using words like meltdown and collapse on live television. Frank's own brother called him that night and told him to pull his money out before there was nothing left to pull out. Frank didn't sell. He kept sending in his $250 that month, and every month after, exactly like he had been doing since January of that year. 13 years later it happened again, except this time it wasn't one bad day. It was a slow bleed that lasted almost 3 years. The dot-com bubble. Between 2000 and 2002, the Nasdaq lost nearly 80% of its value. Companies that were supposedly going to change the world evaporated overnight. Gas station attendants were talking about it. Radio hosts spent entire segments arguing about whether the tech industry would ever recover at all. Frank watched his account shrink month after month after month while coworkers pulled every dollar out of their retirement plans and hid it in savings accounts earning almost nothing. Frank kept buying. Then came September 2008. Lehman Brothers, one of the largest investment banks on the planet, collapsed in a single weekend. The market fell more than 50% from its peak. This wasn't one bad company anymore. This was banks failing, families losing homes, and anchors openly asking on live television whether the entire financial system was about to fail. Frank's own advisor called and gently suggested moving to cash for a while just to be safe. Frank said no. Then in March 2020, the fastest market crash in history hit. 34% of the market's value gone in 33 days because of a virus nobody could see. Every headline said the exact same 4 words. This time it's different. 4 separate moments, 4 separate reasons to believe the stock market was permanently broken. And here's the part that should stop you in your tracks. If Frank Doyle had simply kept investing that same $250 a month through every single one of those disasters, never panicking, never pulling out, never trying to guess when it was safe to jump back in, his portfolio would have averaged an annual return of 11.23% all the way through today. Do you know what $250 a month turns into at that rate of return since 1985? $1,841,521.80. Let that sit for a second. A warehouse supervisor, not a Wall Street trader, not someone with a finance degree or inside information. A guy who kept doing the same boring thing every single month while the entire world told him the sky was falling. And the wildest part is that this story isn't rare. It is the single most repeatable outcome in the history of the American stock market, and today I'm going to show you exactly how to build that same machine in your own life, piece by piece, starting with the one account most people your age haven't opened yet. Hey, I'm David Marshall, and this channel exists for one reason: to take complicated money decisions and make them stupidly simple so regular people can build real wealth without needing a finance degree. If that sounds like something you want, hit subscribe right now because I put out videos exactly like this every single week, breaking down the psychology and the mechanics behind building wealth the boring, reliable way. Now back to Frank, because his story is about to get even more interesting once I introduce you to someone else from that same neighborhood, a guy named Gary Whitfield, who started at the exact same time with the exact same amount of money and made one different choice that changed absolutely everything. Gary Whitfield lived 4 houses down from Frank back in 1985. Same job, same paycheck, same $250 a month going into the market. But when Black Monday hit in 1987, Gary panicked. He pulled everything out and sat in cash for 2 years, waiting to feel safe again. By the time he got back in, the market had already recovered most of its losses without him. Then the dot-com bubble hit, and he did it again. Sold at the bottom, sat out, missed the recovery. By 2008, Gary hadn't learned a thing. He sold again, convinced the entire financial system was collapsing for good. Today, Gary Whitfield has around $42,000 sitting in a savings account. Frank Doyle has over $1.8 million in his portfolio. Same income, same starting point, same amount invested every single month. The only difference between them is what they did with their emotions during 4 scary headlines. Financial psychologists have a name for this: panic selling prevention. It might be the single most valuable skill you will ever learn about money, more valuable than picking the right stock, more valuable than timing the market perfectly, because here's the truth nobody tells you. You do not need to be smart to get rich in the stock market over the long haul. You need to be boring. You need to be the person who does not flinch. There's a reason I opened this video in 1985 instead of last year. Historical data shows you should be able to endure the storm because every single market crash in American history, every one of them has eventually been followed by a full recovery and then new all-time highs. The Great Depression, World War II, the oil crisis of the 1970s, Black Monday, the dot-com bubble, 2008, COVID. Every single time the headlines said the same thing, that this crash was different, that this one might not come back. And every single time the market came back and then it kept climbing. That's not blind optimism. That's roughly a century of documented history. I'm not telling you this so you feel invincible. I'm telling you this so that the next time you see a red arrow on your portfolio and your stomach drops, you remember Frank Doyle sending in his $250 during the exact week Lehman Brothers collapsed. And you remember that historical resilience isn't a personality trait. It's a decision you make every single month, regardless of how you feel that day. Here's the uncomfortable part nobody likes to admit. Panic selling doesn't happen because people are stupid. It happens because of how the human brain is wired. Behavioral economists have a term for it called loss aversion, and it means the pain of losing money hits your brain roughly twice as hard as the pleasure of gaining that same amount. When your portfolio drops 20% in a week, your brain doesn't calculate probabilities and historical data. It sounds an alarm that feels almost identical to being chased by a predator. Your palms sweat, your chest tightens. Every instinct screams, get out now, protect what's left. That instinct kept our ancestors alive for hundreds of thousands of years. It is completely useless and often actively destructive when applied to a diversified portfolio of 500 of the largest companies in America during a temporary downturn. Gary Whitfield wasn't weak-willed. His brain was doing exactly what evolution built it to do. The people who succeed at this, people like Frank Doyle, aren't the ones with stronger willpower or higher IQs. They are the ones who removed the decision entirely by automating it in advance, so that in the moment their brain is screaming at them to sell, there is no button left to press because the system is already running quietly in the background. That is the real secret behind panic selling prevention. You do not out-discipline your own nervous system in the middle of a market crash. You build a system in advance that doesn't require discipline at all. That is what psychological armor really looks like. It is not confidence, it is preparation. So how do you actually build this machine for yourself? It starts with where you put the money, not just how much. If you invest through a regular taxable brokerage account, every time you sell an investment for a profit, the government takes a cut through something called capital gains tax. Depending on how long you held the investment and your income bracket, that can quietly eat a real chunk of your gains over the years. This is why the very first move is opening a tax-advantaged account, and for most Americans that means a Roth IRA. Here's why it's so powerful. You contribute money you've already paid income tax on, and in exchange, every single dollar of growth inside that account, the dividends, the capital gains, all of it comes out completely tax-free in retirement. Right now, for the current tax year, you can contribute up to $7,500 a year into a Roth IRA if you're under 50, or $8,600 a year if you're 50 or older, thanks to catch-up contributions. These limits get adjusted periodically, so always check the current number before you contribute, but the principle never changes. Maximize the tax-advantaged account first, because letting your money compound completely free of capital gains tax for 30 or 40 years is one of the biggest legal advantages available to the average person. Over 4 decades, that tax-free growth alone can be the difference of hundreds of thousands of dollars compared to investing the exact same amount in a regular taxable account. Once your account is open, the next decision is what actually goes inside it, and this is where most beginners overcomplicate things. Inside that Roth IRA, the single most repeated recommendation from people who have actually gotten wealthy this way is the same: an S&P 500 index fund. This one fund gives you a small slice of the 500 largest publicly traded companies in America, from Apple to Microsoft to Coca-Cola to ExxonMobil, all in a single purchase. You're not betting on one company surviving. You're betting on the overall direction of the American economy over decades, which historically has only moved one direction, up, with plenty of terrifying dips along the way that we already covered. Here's a detail almost nobody talks about that quietly accelerates everything: automatic dividend reinvestment. Many of those 500 companies pay a small dividend every quarter, and instead of taking that cash out, you set your account to automatically buy more shares of the S&P 500 index with it. This is called the accumulation phase, the years where you're building your position and reinvesting everything back in, as opposed to the distribution phase later in life, when you actually start withdrawing income from the pile you built. During accumulation, automatic dividend reinvestment is essentially a second, invisible paycheck that buys more of your future without you lifting a finger. Frank Doyle never once manually reinvested a dividend. He set it up once in the 1980s and never touched it again. And that brings me to my favorite rule in this entire video. The less I have to think about, the better. Now let's make this real with something you can test starting tomorrow. I want you to actually try this, not just listen to me talk about it. I call it the Starbucks coffee experiment. A daily coffee habit at a place like Starbucks runs about $5 a day for most people. That's $150 a month, or around $1,800 a year, just from one small daily habit. Here's the experiment. Instead of spending that $5, or in addition to it if you're not willing to give up your coffee, set up an automatic recurring transfer of $5 a day into an S&P 500 index fund inside your Roth IRA, and genuinely check back on your account at the exact intervals I'm about to mention. After the first month, your account might show around $150 plus or minus whatever the market did that month. Underwhelming, honestly. After 3 months, you're looking at somewhere around $450. After 6 months, you're around $900. This is exactly where most beginners quit because $900 doesn't feel life-changing, and I understand that completely. But here's what almost nobody sticks around long enough to see. That same $5 a day, invested consistently into the S&P 500 index for 30 years, at a historical average return of around 10% annually, doesn't turn into a few $1,000s. It turns into more than $300,000 from a coffee habit. Start young. The difference in your growth is absolutely crazy because the first few years of this experiment feel boring and small, and the final few years are where almost all of the actual growth happens. That's not a sales pitch, that's just how compounding works. It's slow, then it's sudden. Now, while Frank Doyle was quietly building his position decade after decade, there was an entirely different group of investors doing something completely different with their time. And understanding the gap between these two approaches might be the thing that saves you from your own worst instincts. On one side, you have short-term traders glued to price charts, obsessing over candlestick patterns, moving averages, and daily price swings, trying to predict which direction a stock will move in the next few hours or days. This is called technical analysis, and it's essentially trying to read the emotional mood swings of millions of other traders in real time. It's exhausting, it's stressful, and study after study has shown that the overwhelming majority of people who try to day trade for a living end up losing money over time. On the other side, you have long-term investors, the Frank Doyles of the world, who care almost nothing about tomorrow's price movement and instead focus on fundamental analysis. That means actually looking at a company's balance sheet to see what it owns versus what it owes, its income statement to see if it's actually profitable, its cash flow to see if real money is coming in the door, plus softer factors like the quality of leadership and how strong the brand recognition is in the real world. When you buy an S&P 500 index fund, you're essentially buying 500 companies that have already proven strong fundamentals just by being large and stable enough to make it into the index in the first place. You're not trying to predict Tuesday, you're betting on decades. And once again, this comes back to my favorite rule. The less I have to think about, the better, because I would rather check my account once a quarter and feel calm than check it 17 times a day and feel sick to my stomach. Okay, let's get practical for a second, because once you're ready to actually put money in, most brokerage apps will ask you what kind of order you want to place, and this trips up a lot of beginners. A market order means you're telling the app, buy this right now at whatever the current price is. It executes almost instantly, but you're accepting the current list price, whatever that happens to be in that exact moment. A limit order means you're setting a specific target price you're willing to pay, and the trade will only go through if the market actually reaches that price. So if a share of your index fund is trading at $450, but you only want to buy it if it drops to $445, you set a limit order at $445 and walk away. It might execute in 10 minutes, it might take a week, or it might never trigger at all if the price never drops that low. For most long-term automated investors like Frank Doyle, market orders are actually the simpler and more common choice, because when you're investing the same amount every single month for 30 years, the difference of a few dollars in your entry price basically disappears into the bigger picture. Limit orders matter more for people making larger, one-time purchases where price precision actually counts. Let's check back in on the scoreboard because I think you need to hear these two numbers side by side one more time before we wrap up. Frank Doyle, same starting income as his neighbor, same $250 a month, same 40+ years. He automated his contributions into a Roth IRA, bought the S&P 500 index, reinvested every dividend, ignored Black Monday, ignored the dot-com bubble, ignored 2008, ignored COVID, and today his account sits at $1,841,521.80. Gary Whitfield, same starting income, same monthly amount. Sold in a panic 4 separate times and today has roughly $42,000 sitting in a savings account that barely beats inflation. The difference between those two men was never intelligence. It was never access. It was never luck. Gary actually made several genuinely reasonable sounding decisions in the moment. Every single time he sold, the news was telling him he was being smart and responsible. That's what makes panic selling prevention so hard in real life. It doesn't feel like panic while you're doing it. It feels like common sense. A market crash always feels permanent while you're inside of it and temporary once you're looking back at it in the history books. Frank Doyle is not a genius. He's proof that if you automate the boring stuff, open the right tax-advantaged account, buy a broad S&P 500 index fund, reinvest the dividends, and simply refuse to touch it during a market crash, time will do almost all of the heavy lifting for you over the long haul. That's the entire secret that finance books charge $40 to explain in 300 pages. Automate it and get out of your own way. So if you want to start building your own version of this starting this week, here's exactly what that looks like. Open a Roth IRA if you don't already have one. Most major brokerages let you do it from your phone in about 10 minutes. Decide on an amount you can automate every single month, even if it starts small, because starting young, the difference in your growth is absolutely crazy, and time is doing more of the work than your monthly amount ever could. Point that money at a broad S&P 500 index fund. Turn on automatic dividend reinvestment, so every payout buys you more shares without you having to remember to do anything. Use market orders for your recurring automated purchases, since over 30 years the exact entry price barely matters. And then before any crash ever happens, make yourself one promise right now while you're calm and thinking clearly. You will not touch that account during a downturn. Write it down if you have to, because the version of you who sees a scary headline during the next market crash is not thinking clearly. Panic never does. But the version of you setting up this system today, right now, while everything feels calm, that version of you is thinking exactly clearly enough to make the one decision that will matter most in 40 years. I want to leave you with something I call the oxygen philosophy, and it's the closest thing I have to a personal rule about money. When a storm hits at sea, experienced sailors don't fight every single wave individually. They can't. The ocean is too big and too strong for that. What they do instead is control their breathing, stay low, hold the wheel steady, and trust that the boat was built to take a beating and still float. Investing through a market crash works the exact same way. You cannot control whether the Dow drops 22% in a single day like it did in 1987. You cannot control whether a virus shuts down the entire economy in a matter of weeks like it did in 2020. Those waves are simply going to keep coming again and again for as long as you are alive and invested. What you can control is your breathing. Automate your contributions so buying happens without you needing to make an emotional decision every single month. Choose a broad, boring S&P 500 index fund instead of trying to guess which single company will win. Put it inside a Roth IRA so the growth compounds without the drag of capital gains tax. Reinvest every dividend automatically. And then, when the next headline screams that this time it's different, breathe, and remember that historical data shows you should be able to endure the storm. Oxygen isn't glamorous. Nobody makes documentaries about a guy calmly breathing through a storm. But oxygen is the one thing that keeps you alive long enough to see the sun come back out. And in investing, staying alive in the market, staying invested through the long haul without panic selling is the entire game. Frank Doyle didn't outsmart the market. He simply outlasted it. And decades from now, I want that same story told about you. If this video changed even slightly how you think about market crashes, do me one favor and hit subscribe, because every week on this channel I'm breaking down exactly this kind of thing: the psychology behind money, the mechanics behind building real wealth, and the boring, unsexy habits that actually make people rich over decades instead of overnight. Drop a comment and let me know, are you more like Frank Doyle or more like Gary Whitfield when the market gets scary? I actually read every single one. And if you know somebody who panic sold during the last dip, send them this video, because the storm was never the dangerous part. The panic was. At the end of the day, the less I have to think about, the better, and now you know exactly how to build that same boring, automatic machine for yourself. I'm David Marshall. This has been Surviving the Market Storms. Stay boring, stay automated, and I will see you in the next one.